All right, my man. So we got a lot to talk about. We've got the U.S.-Chinese trade negotiations, which I guess we'll start there because I had a conversation with Carmine today, and he laid out some pretty good information as far as what we could expect, not necessarily from a trading perspective per se, but different scenarios and whatnot. But my question to him was, he talked about the players that are involved, and we've got Navarro and Lighthizer, right? Lighthizer, that's how you pronounce his
Correct.
name. And they're in more of the hawkish camp, right? And my question to him was, if you wanted a positive narrative coming out of that, why would you have these guys in as opposed to some of the more, I guess, what you would call dovish people, dovish members in that camp?
Okay, so I would say you want to establish credibility that you're not caving on something to save face, and so everybody knows that those guys have the credibility as far as, you know, serious protectionism on the one hand and specifically China hawkishness on the other.
Okay.
And I think you have to look at the real big picture to understand what's happening here, and I think trying to boil it down to what's happening right now or, you know, in the next few days, you really need to kind of pan back and take a big sort of satellite kind of view of this whole process. And I think the big thing with this process is that China has made very clear over the last, particularly the last 2 years, that it is looking at basically, if you think of like a 50-year plan of building something like an imperial path to global superpower dominance for 21st century global economy. Like that they've got this. The two initiatives that really solidify that are the One Belt, One Road and the Made in China 2025, and they really put that out there. And there's no way that Xi Jinping, who's a very outward-looking leader, there's no way he didn't know that there wasn't going to be some kind of backlash coming from the United States. But I think the Trump administration taking over was maybe a step further than he would have assumed to see such a shift toward trade protectionism in general, even besides the sort of battle between the U.S. and China that's slated to kind of be the main battle on the world stage over the next couple decades. Even besides that, you've got a protectionist administration just, you know, in its own right. And I think that there's no way China wasn't prepared for some kind of backlash. And the way that they're trying to do what they're doing is really, if you think about, like, I mean, the Roman Empire was built on building roads everywhere, and the British Empire was built on controlling sea lanes. And after World War II, the United States kind of took that baton and in the same sort of style. And China is really trying to do it with advanced telecom infrastructure in a lot of ways. And that's why we see this propaganda war against Huawei and ZTE. It's really because they're sort of the Chinese version of the East India Company, if you think back in terms of how the British Empire was built. Mm-hmm. And you know, we're pushing back against that, and of course we are. But this is the struggle that's kind of behind the scenes and you know, between the lines that's really going on here, is about, you know, who's going to dominate the global economy in terms of really setting the terms of trade for decades to come. And the United States is pushing back right now, but the situation right now for Trump is he's kind of embattled at this point, especially after the sort of shutdown caving kind of idea. And he needs a win. You know, he needs something to chalk up, hey, I delivered this on my checklist of campaign promises. And I think that he may be particularly vulnerable right now to taking an offer that allows him to save face and put up some kind of win. And China, at this point, may be willing to give him something that has to do with really reducing the trade deficit and China buying lots of agricultural goods, but not having to turn back on its process of trying to establish its big picture themes over the next decade or two in terms of kind of dominating the next level, the sort of, you know, 2.0, 3.0, 4.0 in terms of telecom infrastructure that's being laid down everywhere, and kind of dominating the lanes of trade of 21st century goods moving around, which are really digital goods. So I think that they don't want to give that up, and they don't want to give up really access to intellectual property to help them speed up their development on that level. And, you know, it's possible that Trump in this situation is more vulnerable to that, and I think sending Lighthizer and Navarro to be kind of heading up this initial round at least grants credibility that, you know, that's not the agenda right now. So I think that's probably part of it. But again, you know, I've said this before, the way that I've been following this narrative, and a useful heuristic for me, has been to kind of look at the situation as China stalling. China teasing and China stalling. They want to slow the rate of tariffs because the tariffs are going to be there because they're not going to give in on the big points under any conditions, ever. That's the way I look at it. And if they can kind of, maybe they can come into the, this and try to play for that it's really hard for them to make these concessions and that it takes a lot of time and that they need an extension or something, but they're really going to be on board with doing something. Give Trump something to take back to his base and say, just so they can extend maybe the deadline for the hike in tariffs to June or July, who knows. But something to kind of extend it out and get it closer and closer to when this becomes a campaign issue and they can maybe hope for, cross their fingers for, a new administration to come into the White House that doesn't have a protectionist bent. But I think that, I think putting Lighthizer and Navarro as the front guys is really about credibility.
All right, so let's lay out the particular scenarios that could come out of this, both good and bad, and maybe a way that we might be able to at least structure a trade out of it.
So, structure trade out of this round of negotiations?
Yes.
I mean, I would say that it is. If I'm not sure that there still is credibility to the idea that they're going to get a major trade deal by March. Okay. So, I mean, if there is though, if there is that hope built into the market, then it's a short in the market. I think that that's the way to look at it. Like you're not going to get. Unless there is there is the idea that we get this sort of face-saving pitch, and Trump really is feeling a little bit more like he really needs something, and as long as he can convince Lighthizer and Navarro to say that they've made some important gains, even if they really haven't gotten China to bend in any way on the issues that are really important here, then I would say, the trade would be to fade the initial pop on the idea that they've made some gains. But I suppose that if Trump is willing to accept just a major deficit encroachment by huge purchases of agricultural goods, then that may be something the market would really like, because the idea of China controlling telecom infrastructure for decades to come is not an immediate concern to this market. It really isn't. It's too vague. It's too far-reaching. And just having the tariffs start to come off and having a thawing of that relationship probably would be a really bullish point. So there is the possibility that if Trump has kind of gradually moved toward the idea that a face-saving kind of quote-unquote win is something he's going to take, and China is willing to give it to him, even though that endangers their possible hopes for getting a new administration in the White House, that may be something the market really likes. So there is the possibility here, especially on the heels of the idea that maybe the administration came up on the losing side of the shutdown situation. There's the idea here that it's possible that we're more vulnerable to a kind of face-saving quote-unquote win with China, which would mean ending the trade war at least on some level. So that's not impossible. What I do believe is impossible is China folding in a substantive way on the issues that have already been outlined as the most important issues.
Okay, so you're already short. You shorted the Nasdaq just a little bit before we got on the air today, and I just wanted to talk a little bit about that trade. And does it relate?
Well, that trade might be over in just a second.
Yeah, I know. It's it's still in motion. You're still. I don't know, what about 6-7 points away from your stop. But what was your thought process about getting short this one ahead of these key events?
So this is really just about relative weakness. The Nasdaq showing a tremendous amount of relative weakness today, and I believe that we are in a more important correction, so I'm going to take shots like this right now. Okay. These are the shots that turn into the big trades when you've got a volatile market. We've got a VIX that's close to 20, and we've got clear relative weakness in the tech stocks. We still have some crosswinds with earnings, but I want to put myself in these sorts of positions when you've got volatility moving in both directions. I believe I noted a couple times that on Friday we saw the put-call ratio go down to under 0.6. Mm-hmm. That's pretty low level, especially for a market trading with a VIX at 19 or 20, and that suggests that Friday we got to the point where a lot of important hedges had started to come out of the market. So that sets the stage for the possibility of a more important type of pullback, I'm not saying we're headed right back to the December lows. I'm saying we are likely to see some sudden and surprising out of the blue, 2.5% down days in whatever the weakest sector is. And you can see this kind of fall off the cliff. And with the Nasdaq, you're sort of sidestepping energy, which we're going to talk about in a couple minutes. And you're sidestepping the financials. And there's your two areas of relative strength, because there's the two areas, and I said this the other day when we were talking, the two areas that were the most washed out in what we saw in December, because that was really about kind of facing up to the possibility that we were suddenly moving into cycle end and into recession. And those are the two areas that are going to take the biggest beating in that type of scenario. So those were really the most washed out. Those are now the most resilient as we start to see data that suggests that that's not very likely at this point. So you're kind of sidestepping that, and you're moving into, essentially in front of Apple, kind of telling us how, years and years and years of seeing the type of growth that they saw from the iPhone is just suddenly gone. So yeah, here comes my stop. So it didn't work out in this case, almost certainly here, but it's the type of position that offers you good probabilistic advantage. When you get the shallow bounce in the relative weakness area of the market at a point where you've removed those big hedges and you've got some volatility in the market, you can get that extension, that 50, 75, 100-point extension in the Nasdaq on 15 points of risk. And that ratio is spectacular, and this is it's a worthwhile position, and it's a probabilistic game, and it looks like in this case I'm going to get popped out as we start to see the S&P really V-bottom it. I mean, we're all the way back into that opening range now.
Yep, we sure are. And for what it's worth, I don't know if you follow them as closely as I do, but it is trading right at today's daily pivot, and that's been a magnet today, overnight as well. So, and then that was right around that unchanged level.
Yeah, and in front of all these, Brexit vote, in front of the Fed, in front of the Chinese talks, in front of the jobs data, it's not surprising to see that kind of pin come in.
All right, so as far as if you were to rank, what's the biggest event that we're heading into? Is it the FOMC? Is it these China talks? Is it Brexit? Is it well, I guess the Venezuela thing's already kind of passed. We'll talk about that towards the end. But out of those three, which is the biggest, or most the one that would give us the biggest catalyst?
I mean, I suppose that it depends on what happens in each case, right? So
most probable.
I would imagine that the way this market is positioned, I think you have to look at what's not being. I mean, there's expectations in place for all of these things, and if all of them go as expected, they're going to have little impact. So, if Powell is a little bit more hawkish again, that would be by far and away the biggest issue. You can look at this whole process as being we saw the Fed essentially come out and do a tough love thing, in December, and then sent the market off a cliff, and then we saw him bring it right back by putting the Fed put back into place in a more official and explicit manner. And if that goes away again, then that would probably be the biggest thing. I think that's the most unlikely thing. However, I don't think that I think that lesson has been learned powerfully at this point. So I would imagine that the market is, one of the reasons why the market is as resilient as it is because it's expecting there to be a situation where the economy is doing better than people thought and the Fed is more dovish than they thought. And that combination is kind of locked into place because of the carnage that we saw in December. And the fact that carnage was not necessarily really tied to a genuine appreciation for where the economy was. So it really taught the Fed a lesson, but didn't really include the major growth slowdown that people were worried about. So I think that that's probably, the Fed is now back to being, the Fed kind of goes back and forth. It's either the market's friend or it's not, and for a little bit it wasn't, and now it is again, at least for the time being. So.
Doesn't it always seem as if somewhere early in the new Fed, the new Fed chair's term, that the market will test their resolve? It gives them a big test to see, hey, what are you going to do about this? It seemed like that. You know what I'm talking about?
With this, I do, and especially with this transition, because it's kind of a transition to a less known quantity. I mean, transitioning from a lot of different of the transitions that we've seen over the past couple of decades have been kind of an establishment culture transition.
Right.
And Powell was really kind of a move to an unknown quantity. And yeah, I think that he made a lot of statements initially that, he he wasn't there to be the stock market's friend. Like, he would say that kind of thing. And that really, I think, forces a more dramatic version of exactly what you're talking about. And it's not like people get together and decide to do this. I think it's one of those interesting things that evolves in group behavior, game theory, and decision making.
Right.
When there's a vulnerability, it kind of flows in the direction of herding action toward testing that, because people aren't willing to stand against that test.
Well, if I recall, I don't think Bernanke was one to say I'm going to be the stock market's friend. He just inevitably turned out to be the stock. Yeah, he just ended up being that.
Proved it. Yeah, right. Actions speak louder than words.
Yeah. But they tested his resolve. I mean, think about when he first got on. That was right in the midst of the financial crisis. Janet Yellen had the same type of thing. I wasn't really around. I wasn't around the markets when Greenspan was in, but I believe he was tested as well, right?
Oh my goodness, yes, and yeah, I mean he laid down the gauntlet right all the way back in '87, so
yeah,
it was pretty clear. I mean, one of the reasons why the '90s was the '90s is because everybody knew that Uncle Greenspan was there, and would always be there, and the LTCM was really kind of the apotheosis of that. But yes, his credentials established probably the original version of the Fed put.
Yeah,
it became a market cushion, and Bernanke couldn't disturb that. And then the events that we went through brought about a real sense of the possibility of a new depression. So he had every reason and right to kind of fall into step with that and to take it to new levels. And Janet Yellen certainly wasn't going to come in and say, I'm going to be different. But the economy and financial conditions had strengthened enough by the time Powell took over that, he finally had the chance to say, things are okay, and we don't need to handle this thing with kid gloves. And the market taught him a very quick lesson.
Yeah, indeed. All right, so let's just touch on the FOMC, because I guess you of all people would be able to lay out the different scenarios. I wish Gavin was here. Unfortunately, he's sick, as you know, and we'll probably talk about it a little more together tomorrow. But just as far as a preview of what you could see happening in the market, I think you said something about this could also be a potential fade coming out of this Fed speak.
I mean, if we're essentially running in front of it, expecting some highly dovish talk, that really is just the process of weekend shifting around. I mean, if you're short, you don't want to be short into Powell saying, yeah, we're going to be there for the market. If anything goes wrong, we will immediately jump to cushion things. You don't want to be short into that, right? And if you are somebody who wants to own something, doesn't own it, you're going to need to buy in front of that, right? So it offsets the market into a lean. And if we get to that point, we get that type of statement, and there's not an immediate large follow-through, then the shorts can put their shorts back on. Then the longs can go back to the sidelines if they want to. It kind of rebalances out. So you can get this anticipatory run into something that then doesn't show a lot of follow-through, and then you continue with the process that we may be in at this point. I'm not 100% positive with that. We are acting better than you would think in a situation where we are correcting such a large run higher. And again, I think that energies and financials are a huge part of that. But, I believe that we're probably somewhere in the process of breaking back under 2,600, at least to test that 2,560 area. And that, that kind of establishing that sort of previous fourth low, which would be maybe 6,500 in the NQs. I think that process is a reasonable consolidation target. And, it's a little bit whippy right now. As we start to plot out those points, but I think that's where we're eventually heading, and it may be that it's on the heels of something like that, something like Powell coming out and reaffirming his Fed put credentials that could lean the market enough to allow for that vulnerability to come in the aftermath. So tomorrow afternoon is a possible point to short for a reasonable swing, or Thursday morning.
All right. I know you've been watching it, and I don't know if we've talked a lot about it, but is the gold giving you any indication of where people may be siding?
Well, I mean, I think gold is in I think it's back in an upward trend. I think there's going to be shakeouts, and I probably want to take advantage of them on the long side. I still kind of hold on to the conversation we had last year in August. I think that this is part of a very large monthly chart time frame ascending triangle that will eventually move back above 1400. And you know, it's acting that way. And I think you've got real interest rates, real yields that are kind of showing up in that direction. The gold market's kind of sniffing that out. If we peaked in real yields for the cycle, which seems like a reasonable idea, and we've got certainly plenty of geopolitical catalysts, although I don't see that as too much of an important point for gold on a sustainable level. But you know, if we've gotten to the point where we sort of maxed out, we've seen some cycle highs, we're going to see some difficult comparisons. We probably have a Fed that's more or less on hold at this point. And you know, eventually there's going to be the need for probably softening of policy. If you look back, the tightening cycle that we've seen is deceptively large. If you look at the Wuxia shadow rate that's put out by the Atlanta Fed, one thing that I tracked back in 2014, that got down to -3%. Basically, it shows using forward rate instruments what the effect of QE was in terms of getting below the zero lower bound in terms of where policy was. So back in the middle of 2014 is when we really got to the lowest extreme, and that was around -3%. And now we're up to 2% and heading possibly higher. But that's, you know, that's a 5% swing in terms of tightening, and that's typical in terms of marking out, you know, the sort of an entire typical cycle as tightening. So it would be pretty reasonable to start to make the assumption that we've seen tightening for this cycle. It's happened. It's come and gone. And if we're now starting to head in the other direction, then you know, gold is kind of out in front of that. And it doesn't wait, you know, and it started to discount that back in September and November as we started to see this quarter take place in Q4, where you know, a lot of the second derivative measures shifted. And it put the Fed in a position where we went from seeing, you know, the dots show 3 to 4 hikes next year to seeing the Fed fund futures show 0 hikes and maybe a cut. So this is, you know, we're at that point in the cycle, and gold's going to respond to that.
All right. So currently, you're not doing anything. Maybe potentially waiting on some pullbacks in gold.
Correct. Yeah. I mean, shakeouts will happen. Shakeouts happen all the time in gold, especially if we get to the point where, you know, we start to see there's enough healing in the markets that the Fed puts back on the table the idea, maybe, of going back to, you know, shifting the dots back toward 2 or 3 hikes for the year. That would be probably a good source of shakeout, and you just have to ask yourself, do you believe that's actually going to happen? And so I think that you'd get the gold market responding to that. It would probably allow you for a low-risk entry point on the bet that maybe then we're going to shift the tables back the other direction again and get back down to no hikes. And that will drive the action. And the dollar is also going to be an important part of that equation, but the dollar has started to respond counterintuitively and negatively to data points, which suggests there's a little bit of incipient weakness there.
And I bring it up, gold in particular, because you've been very active over, not lately, but over the course of the years, very active in gold, and you've done really well
Yes.
in it. And is it something, since we have a lot of new listeners and people checking back in with us, is it something that is going to be on your radar that you're going to be looking forward to as the months progress throughout this year?
Yeah, I think now we've gotten back into a trending environment. It's going to be, you know, you're using your gold in an uptrend playbook, and that really is just about taking advantage of shakeouts. They can get really violent and really emotional, and that's what's beautiful. You wait for that spike in emotion, that air pocket drop through a level, that, you know, 30 points in 90 seconds kind of move, and you buy it, and then you hold it. It's just finding those moments. If you believe it's in an uptrend, you know, we played this way in 2009, 2010 in gold, and it was fantastic. It's just, you've got to find those moments where you get that emotional spike to the downside, that air pocket drop through a level, and you really clear it out. You clean it out. Because if you look underneath the surface, there's not a lot of crazy speculative interest right now. It's rebuilding, but it's going to have shakeouts and dips, and you just want to kind of find those little pukes and put very small size on with very wide stops and just let it rebuild and develop.
All right. So I noticed that the FTSE closed up more than 1% higher. It pretty much led the way in Europe today, and this is interesting because it comes ahead of the latest round of Brexit votes that are going on. So I guess there's some optimism going on there. What's your overall takeaway of what we're seeing as far as Brexit?
Well, so, I mean, today in, about an hour and a half, we're going to see a series of votes on amendments to May's major Brexit agreement pitch. Rather than rebuilding one from scratch, they're attempting to amend the one that's there. But as far as I understand it, there are three main votes, and they're probably all expected to fail. So it really doesn't necessarily change anything, but I suppose that, as far as I understand it, this is kind of a process of showing the folks in Brussels the sorts of things that they would need to be able to move forward and get past this. And I think really what it all comes down to is I think we're going to get to this question eventually. Does the EU want a no-deal Brexit? Right? Do the folks in Brussels want to hold firm to the March deadline and say, if we haven't agreed on something by then, there's just a sort of, thrown out of the car kind of exit from the Eurozone? And, that really comes down to, I would say, the fact that there's a tremendous integration of these economies right now. And there's a lot of people that would suffer. Everybody suffers in that kind of situation. So I would think that there would be an impetus to allow a further extension of the deadline, even though the way that May is putting everything right now suggests that's not the case. Of course she is. She wants to put pressure on people to pass amendments to the agreement she's already put together, so they've got something that can actually get this done. If everybody rejects everything today, which is, I suppose, kind of expected, it may still shore up a sense that there's going to be an extension, so it could end up being a kind of bullish fail. And I think that we saw that last time, too. So there's this, the pound has done nothing but run higher since the last agreement vote failed. There's this counterintuitive action, which is more about kind of putting in place a process that can work, because the current process that's being done here, sort of, it's hampered. It really can't work the way they're trying to do this, so they need to have time to be able to put together a process that can work. However, I suppose there's a dark horse possibility that the EU also has to think about Italy. They also have to think about the possibility over the next 24 months, especially if we get some down cycle stuff, that they're going to have other possible exits on their hands, or at least people considering that, or votes gaining traction, pitches gaining traction, propositions gaining traction in other places that are thinking about possibly leaving. And the one way to stop that is to make things as hard as possible for the UK, and to put the UK in the worst possible position, because it sets the precedence. It's a symbolic kind of show of here's what happens if you try to exit. You're going to have this terrible time. It's going to derail your political situation. It's going to derail your economy. It's going to be a long, drawn-out, painful process. And that makes it less likely for the folks in Italy who are trying to gain support for an Italian exit to really get their way. And Brussels obviously, would prefer. People felt like there is a huge obstacle to getting support for that kind of move. So in long-range thinking terms, it is possible that they will want to not extend the deadline and force a no-deal exit. However, I personally think that that's too much foresight, and the EU has not shown a tremendous amount of foresight. So I would imagine that all three votes are going to fail, and that we will eventually get a natural extension of this deadline. But we'll see.
All right. Is there any way to trade this? Maybe something in the pound?
I mean, it's already happening. Like all these votes are expected to fail. And just like you said, the FTSE was the best performer. So I don't, the pound has already been running into this, and it's not because the votes are expected to succeed and that we're supposed to wrap this up in a tidy, efficient manner. So, and there are certainly traders out there that understand the Brexit situation better than I do. As I've said in the past, this is kind of one where I've taken a punt on, because I knew that it would be all I'd be focused on, or I wouldn't be focused on it enough. And I chose to not be focused on it enough because there's too much else to be focused on. And I really think you have to, there's been so many terms invented over the course of this negotiation. There's been so many concepts with counterintuitive relationships to each other that have come out of this that, I think that you have to focus so much of your time and energy to you got to get past the point where you basically know the broad strokes. I understand the broad strokes, but to have an actual market edge, to understand it better than people who are paying $1 billion a year for research understand it, is unlikely, unless this is all you're doing. So, I'm not sure that I see anything that I would consider to be a worthwhile risk off of this.
All right, so why don't we move into crude oil and this big move up? We're up about $1.50 right now, and the only thing I could come up with are these Venezuela sanctions. You seeing anything else?
Yeah. So what were you saying when you said that's resolved earlier?
I don't know. What do you remember the context?
You said we'll get to Venezuela, but it looks like that's resolved.
I think I might have misspoke, or I might have been thinking about something else.
Okay, I just was wondering if you saw something I didn't, because
no.
Yeah, I mean, I think this is an interesting situation. I mean, obviously, it's a bull item for crude, but I think that it's not just because Venezuela can't export oil to the United States. I think that's the main thing to understand here. U.S. sanctions on Venezuela. The main result of that is that there's a diluent that is imported from the United States to Venezuela that is necessary for Venezuelan oil to be exported to anywhere in the world. Venezuela has the heaviest oil in the world, right? It's like sludge. It can't even be piped. It's too thick. Mm-hmm. It needs to be diluted with something else and mixed together into something that can be piped and then refined. So Venezuela can't export oil to anywhere in the world unless it has access to diluent. And up until now, the primary place that was coming from was the United States. We would send stuff down there. I think it's called naphtha. We would send it down there. They would mix it with their super sludgy, heavy oil, and they would then be able to get it into pipes, pipe it out, and send it to the United States, or refine it there and send it to the United States. And then we would mix it with shale oil. Because they're super heavy oil, shale is super light oil, you have to mix the two, and then you refine it and turn it into gasoline or whatever else. So it's like there's a bunch of recipes, or there's a bunch of ingredients in a recipe to make the stuff that we really use. And Venezuela provides the heaviest, thickest, sludgiest oil in the world. And they've got a problem exporting it to anywhere if they can't get access to diluent. Now, they get some from Russia, they get some from Europe, they get something else from, I think, Algeria, but it's not enough, and it primarily comes from the United States. And Europe is allied with the United States on the issue here that's really underneath this, which is, will Maduro keep power, right? So will the military in Venezuela remain on the side of Maduro and the Maduro administration, or will it shift over to, what's his name, Guido? What's his name? Do you know?
I butcher everybody's name, so I don't even want to do it.
I'm sure I'm going to butcher this one. But it is Guaido, maybe? Juan Guaido? Juan Guaido. That's what I'm going to call him. I apologize if that's wrong. But the United States, Canada, a bunch of other countries have come out and basically said, we recognize Juan Guaido as now the new president of Venezuela. And so the sanctions, actually, I believe that the way that this is structured is probably going to be effective. I think that, I don't know how you keep the military on your side if, I mean, oil is where they get their money. If the money faucet has essentially been cut off from the country now, pretty much, from everywhere in the world, because the United States is not supplying them with the diluent needed to get their oil exported to anywhere. So I feel like this is something that could actually wrap itself up pretty quickly, which means any extended bounce in oil probably could be a fade at some point, simply because, this could move quickly. The military could suddenly shift to Guaido because they need the money. The military ends up getting shut down at a certain point. These people have to eat too. And that's where the money is coming from, is oil. And without the diluent, the money stops. So, it's like cutting off oxygen to a room where people are in. All they have to do is push a button and the air comes back. And pushing the button here would mean shifting from Maduro to Guaido. And it just seems like it's tough to stop that, and it could be quick. But we'll see. I think that it's an interesting strategy, though, simply because it really does. It's not just sanctions with the United States. It kind of cuts them off from the world.
Yeah. Well, let's see. So, remember when we were talking about that big build and we saw crude rising? I wonder if this was kind of in the pipeline.
I bet it was. I bet it totally was.
Yeah, so a week later we find out what that big move was all about.
And oil is notoriously bad that way because it's not regulated. It can't be. There's no way for regulators to stop any form of insider information. You can. There's no international oversight body on the trading. So. And
it was the perfect opportunity based on that data.
Oh, yeah.
Based on that data to do this.
You got to think OPEC principals can literally be sitting there trading futures while they're talking. I mean, just, it's a pretty tricky market that way. So yeah, I would imagine that this was in the works. And when you understand what's going to happen, you can get an awful lot of money lined up to follow it. So that would be certainly an explanation for how crude is behaving.
Well, then I would think that there's probably still even a bit more room to go if there's a big squeeze going on.
It would appear, yeah.
So,
right. I mean, we could pop above those recent levels. We can get really above the range that we saw back in early December, which puts us up probably for a test of 55. And then you can move from there. If this is able to resolve quickly, if we get note within the next week or so that, you know, we're starting to see the military shift their allegiances, it could be that quick. Then, you know, the market will probably start to discount the idea that those sanctions will be lifted pretty quickly.
All right. So we did cover a lot of ground here. Are you going to err on the side of caution just ahead of some of these events, wait for some of the dust to settle?
Yeah, I think probably at this point. I mean, there may be a setup. It depends on what setups I see. If I see something that's really compelling just come together this afternoon, I'll take it. And, you know, there's the relative weakness in the Nasdaq is not related to any of these catalysts. That's just simply what's happening. If the action around the rest of the market will allow for that to clear down, retest the lows, then there could still be a trade there, or it may be something that we do after the Fed tomorrow.
One of the things that you like to do is handicap what the market may do, particularly after Apple's results. They've been a big mover in the Nasdaq. Does that scenario kind of have less weight because they already pre-announced, so there's not a whole lot that may be baked into the action, and then we have the Fed just, you know, the very next day?
Yeah, I mean, if anything, I suppose that, you know, they announced the news they already announced, and there's still some kind of knee-jerk chop down, and that turns out to be a possibility to buy in front of the Fed.
Okay. All right. So we've laid out a few scenarios. Anything else that you think we left untouched?
No, I think we pretty much covered it well. I mean, obviously the jobs data is at the end of the week, too, and that's going to impact. The Fed probably has a pretty decent idea of what's coming there, so what we hear from Powell may help us understand what we're likely to see on Friday morning. And the dollar's kind of woven into everything, so that's going to be, I mean, that's one of the most important data points that we're going to see come down the pipe at this point. As we continue to kind of get to this situation where we're trying to figure out how much of a slowdown that, you know, we're kind of involved in right now, and I would suggest that the biggest issue is really the comps, that what we went through last year, particularly when we headed to Q2 of this year, Q2 and Q3 this year, you're just going to see, I mean, the most difficult comps that we've seen in a long, long time. In fact, I saw something where somebody was saying that the shift in top and bottom line overall, just on a comparison basis, is worse than we saw coming out of the 2000 top right now as we head into Q2 and Q3 this year. And a lot of that is because of the fiscal stimulus that we saw put in place last year. And we're kind of battling against that as that goes out of its window of primary effect zone. So, you know, everybody's positioning in front of that difficult headwind that's heading at the market, which is why I wouldn't be super bullish for just a continued run straight back to the highs right now. I think we'd kind of run into a congestion zone, and we've got to deal with that process and kind of let it play through. So I don't think we're immediately headed into recession by any means, but we're in some form of comparative slowdown relative to what we had last year. Everything looking year over year, it's just tougher and tougher and tougher to kind of move the needle in terms of growth. And I mean, obviously, you know, the employment picture is going to play into that. So we're going to get an increasing sense of traction with understanding where we stand in that process. And this is definitely going to be one of the biggest data points. But earnings are just as big.
All right, well, we got a whole slew of earnings, and we didn't take a huge dive into the FOMC, and I wanted to save some of that commentary. Hopefully Gavin will be back tomorrow, and we can take a deeper dive into that. You and him usually have some really good conversations. Oh, you lost me again?
I just lost you for a second.
Oh yeah,
just for a second.
Okay, I was.
What did you just say?
Yeah, I was just saying that I'm hoping to have Gavin back tomorrow, and you guys can do a little more thorough analysis of what you can expect from the Fed. He's really dialed in. You guys have really good conversations and ideas that you bounce off each other. And the best part was we've done this quite a few times, is the post-Fed analysis, and where you guys break down those trades. So hopefully we can get that on the books for tomorrow. That would be good stuff for all the listeners, and selfishly me as well.
Yeah, absolutely. I mean, last time was really one of the most interesting versions of that, where we kind of got on Powell's case a little bit and so did the market, and lined up a few good shorts.
Yeah, well, I think it worked out nicely. If anybody out there remembers that, that was around the that was during the Christmas holiday period, right before Christmas time, right?
Yeah, well, that was the thing that sparked the kind of more excessive and aggressive version of the crash that we saw in December. That was kind of the final straw that broke the camel's back of support from the November lows and really sent us into that spiral.
Well, what I told you a lot of people, like the prop traders and whatnot, would be off the desk. I said, watch out for those big moves. They may be a little bit more extended than you would even expect on those times. So kudos to you, because I know you took advantage of it. I just rested my voice. So, all right, my man. Hey, I got one question for you. This comes from a listener, and the question is, they recently started following Briefing Trader and wants to know if there's any particular reason why we don't trade Forex. And I'm going to question it. I'm going to address it to you, because you're probably the most likely one to trade it. I know you dabble in it from time to time, and Gavin does as well, opportunistically. But just overall, why you don't trade it so much?
I think, yeah, I've traded quite a bit in Forex, and I think that right now there's been so many other opportunities that it kind of falls down my list a little bit, and we have a consolidative environment in most of the major currencies that I see. I mean, we've had essentially and I think the yen really kind of captures it for me. When the yen is in the trending market, I trade Forex quite a bit more. But we've had the yen going sideways essentially for, in a sideways narrowing triangle for basically 2.5 years. And that's really quieted that down. We did some euro trading after it had crashed and started to make its comeback. But I think that, we've seen a lot of larger time frame consolidation patterns, and we've seen a lot of trending action in other assets. So it's become kind of demoted for me on my list of priorities as I take a look at where opportunities are. But I would imagine with that triangle in the yen coming to a head, and it definitely is, that's probably going to become an increasing priority during 2019, especially with the move in gold, because gold, for me, kind of plays into that same picture. Mm-hmm. So yeah, I mean, we do. I trade the yen, I trade the euro, I trade the pound, the Aussie dollar, the Canadian dollar, Mexican peso back in 2016. Oh, yeah. Mm-hmm. And probably the majority of my currency trades have been in the euro or the yen, which certainly isn't uncommon, and I consider gold to be kind of a part of that. Gold, the euro, the yen. But occasionally the Australian dollar or the Canadian dollar would become more important to me. The pound less so. But yeah, I definitely have traded a great deal of Forex over time. I usually trade it in the futures market, which is perhaps a little unconventional, but it's because I kind of have my platform and my process, and there's excellent, highly liquid futures on the CME for currencies, and I can think of it all in the same direction rather than thinking of switching the denominator currency. So it just kind of flows better for me. But those trades can easily be interpolated if somebody's trading on raw base Forex.
Right, and that was going to be actually part of my next question, because I wasn't sure if maybe the listener meant, why don't you trade specifically in the Forex spot markets as opposed to just the futures market. So I wasn't sure the context of the question. Hopefully that answers it for you, though. You can definitely trade them both. If he does something in the euro futures, you can do it in the euro spot, and you just
pretty easy to translate over.
Yeah, you just have to adjust your risk accordingly. Make sure the various levels that you have line up with the spot market and whatnot. So it's not that difficult. It's certainly a lot easier than adjusting for ETFs versus index futures, let's say, and that's not all that difficult either. So.
Right.
All right. Well, Brett, I think you and I will reconvene, same bat time, same bat channel tomorrow, hopefully with Gavin on board, and we'll talk a little Fed.
Got it.
All right, my man. Thank you so much for joining us. I'm sure the listeners appreciate it, and I sure do. And we'll reconvene tomorrow.
Okay, great, Jim. Thanks.
Thank you, Brett.